Thanks, Bethany. I'll get us kicked off. I like to see the attendees that are like myself as our attendee number climbs here just a little bit after 11. Just hopping on last second here to get the content. But welcome, Individual Tax Planning in a Down Market webinar. We'll start off with some introductions. I'm also the official clicker, so if you see me looking around, I got multiple screens going on here. There we go. I'm Adam Heathcote. I am the managing director. I'm a senior wealth advisor in our St. Cloud market. As managing director, I get to run the advisor group for our Bloomington and St. Cloud offices. And my days spent, working on planning with clients, certainly talking about the stock market and connecting with the CPAs to do tax planning. Heather, why don't you introduce yourself?
You bet. Good morning. I'm Heather Gunderson. I'm a tax shareholder out of the Waterloo market. I specialize in individual and small business taxes and work with clients on both our wealth management side and our CPA side. And I specialize in trust, gift, and estate taxes and get to work with clients all over our geographies.
Good morning, Abby Lubazinski, the Wealth Management Tax Director in the Twin Cities market, and I specialize in the tax planning and the tax returns for our wealth management clients.
We will continue on to an agenda here. So we'll start off with a quick market update. Certainly this webinar could have just been called year-end tax planning, but since we did have a down year in the market, to add that little buzzword to it, what challenges and opportunities arise with the down market. So we'll touch briefly on where the market sits, hop into general tax updates, and then we'll get into some specific planning opportunities, and then certainly leave time for question and answer at the end. First, a little bit about Bergen KDV. We're a professional services firm. We have north of 30 different unique offerings for small, medium, even large businesses. Certainly, the majority of what we will talk about today is our tax and wealth management offering, but certainly we have many offerings for small, medium, and large businesses. We're a Midwest company. Certainly on our wealth management side, you can see there we are over $2 billion in assets. As a firm, we have 600 employees. There's 30 within wealth management. One of our biggest assets as a wealth management company is the fact that we do have north of 200 CPAs within the firm, and certainly across the firm we have 15,000 clients. You can kind of see the geography. We have 3 of those, 8 different dots represented today. So certainly we have an office near you, and with webinar and Teams and Zoom, we're always able to connect with clients. As we move along, I apologize, you'll have to listen to me quite a bit at the front end, but then we'll get to the real talent, Heather and Abby, shortly, but we'll start with the market update. This slide is kind of representing through October, the end of October, so certainly we've had market activity in November. I'll try to give high level, but you can see on the US equity side, pretty much negatives all across the board in the year to date. And certainly on the stock side of things, we never like to see a down year or even a down quarter, but we certainly understand we need those in order to see the growth over the long term. And honestly, other than the NASDAQ, being down close to 30% at month end, the rest of them are pretty much within range of what you would expect for the stock market, right? On the bottom side, that down double digits, 15, 20%, that's got to happen every so often in order for on the upside to get 30, 40% opportunities. And I think largely, the equity side of things, it was a little bit overbought at the end of last year, so we were probably due for a little bit of a pullback. I think some of the extended pullback has more to do with what's going on in the fixed income side. So on the right-hand side column there, you see that fixed income, and that's where, really that's the more challenging environment. As you see those year-to-date numbers, we expect our fixed income as our conservative investment to, we certainly understand it can be negative. So But our normal range on that fixed income side is, maybe down 2, 3, 4% to on the high side, 7, 8, 9, maybe 10%. So for us to be down this much in a given year is really the outlier. And of course, we all know why. The Fed has raised rates. They are trying to slow down the economy to rein in inflation. And I do think we're starting to see the fruits of those labors. And ultimately, too, the Fed has even hinted at they are going to start slowing down. Hopefully into the first quarter, maybe second quarter next year, they might even get to where they level off. And certainly then we will start to see that bond market recover. But ultimately, in a nutshell, this is where we're at year to date. Certainly we look for better opportunities in 2023. But as long as we're in this environment, this is where we have this opportunity to talk to you about, hey, how can we try to make lemonade out of the lemons that the market has given us? So that's what we'll focus on today. We'll hop into some general tax updates.
Great. We wanted to start off with some items that have expired for 2022. For those of you that were with us on last year's webinar, we discussed some enhancements as part of COVID relief. That relief has now largely been expired for 2022. First off, with the child tax credit, in 2021, there was an increase in the per child credit amount from $2,000 to $3,000 or $3,600 for kids under 6. That's back down to $2,000 for 2022. Also, the child independent care credit in 2021, there are enhancements to that credit. Those have also expired for 2022, and we're back down to the pre-2021 amounts. The recovery rebate credit, after 2 years of managing those pandemic-related stimulus checks or the recovery rebate credit checks on your tax return, there were no rebates or checks in 2022, so this will not be part of your 2022 tax filing. And finally, last year, there was a $600 charitable deduction allowed for those that take the standard deduction. Back in 2020, it was $300. This has also been fully expired for 2022. So unfortunately, there is no additional charitable deduction for those that take the standard deduction this year.
Okay, so for 2022, after a whirlwind of tax legislation, right, in 2019, a complete overhaul, 2020 and 2021 with COVID relief, 2022 has actually been a quiet tax year, which is good for CPAs, right? We can get our arms around what the rules are, consistency in the tax code, and help do better planning. So it's greatly appreciated. Last year at this time, the bipartisan infrastructure deal was signed into law. That was November of 2021, but it actually had very few tax provisions with that. That was mostly infrastructure. There was rules in there to end the employee retention credit early. That ended at September 30th of 2021. And then another major thing in that bill was the crypto asset information reporting requirements. It redefined who a broker is to anyone who takes consideration for transactions. And now there is broker reporting required for that crypto asset information. So that's impacting 2022. Of course, there's some rumblings now that the election has passed and we've gone Democratic Senate, Republican House. There are some that speculate there could be some final pushes to pass Democratic agenda items before the end of the year, before the Congress shifts. There has been proposed retirement legislation in Congress since July of 2020. They nicknamed it Secure 2.0 now, but there has been bipartisan support for that since July of 2020. It has some provisions in there such as tapping 401k for emergencies, increasing the savers tax credit, mandating 401k enrollment, upping the catch-up contribution from the $1,000, making part-timers eligible for 401k plans, and then raising the RMD from 72 to 75. There's a 5 to 10 year phase-in of that. That's not law. So that's in this proposed retirement legislation. So right now it's currently at age 72, but just be aware that Secure 2.0 could pass in December 2022, or just a general tax extender bill is pretty popular at the end of the year as well. So some of those things that Abby just talked about maybe will get extended at the final hour. So keep looking at our website. We'll be sure to update if any December tax legislation changes. So a few things that did pass during the year. The first one is automatic penalty relief. So in September of 2022, the IRS issued notice 2022-36, which provides penalty relief to most people and businesses who filed their 2019 or 2020 tax returns late. So to qualify for this relief, any eligible income tax return not already filed needed to be filed by September 30th of 2022. The IRS is also reviewing accounts and is taking additional steps to refund any penalties that were paid. So this relief applies to the failure to file penalty only. It's really in response to COVID. This penalty is typically assessed at 5% per month or 25% of the unpaid tax when the federal return is filed late. So there's a full list on the IRS website, but individuals, estates and trusts, corporations, nonprofits, and partnerships all could be eligible. Another thing to talk about that's been clarified is inherited IRA distributions for 2021 and 2022. So RMDs for everyone were suspended for tax year 2020 due to COVID and the market decline. So the IRS has answered some penalty questions regarding these missed RMDs. The Secure Act was originally passed end of year December 2019 and made substantial changes to the retirement account rules. So one of the most notable changes was the elimination of the stretch provision for non-spouse beneficiaries on inherited IRA accounts. So this is for deaths after January 1, 2020 and after. So now most non-spouse beneficiaries are required to deplete their accounts within 10 years of the account owner's death. So there were outstanding questions whether they would have to take an annual RMD as well. And the IRS has come out February of 2022, which was 2 years later, to clarify that yes, these beneficiaries are required to take an annual RMD along the way and have the account cleaned out by the end of 10 years. So the IRS issued proposed regs to clarify that, but because of the delay, the 2-year delay in that, the IRS has subsequently come out October of 2022, just last month, with notice 2022-53, which waives that 50% penalty for the missed RMDs for 2021 and 2022 on inherited retirement accounts. They also did not say anything for 2023, so they just clarified that yes, you had to take them for 2021 and 2022. No penalties would be assessed. So that kind of suggests that they're going to get those proposed regs finalized, in soon, right? So that's clarified for 2023. Okay, so the next, the only piece of legislation passed is the Inflation Reduction Act. So the Build Back Better, does everybody remember that? The BBB Act, right? It was a hot topic in 2021. Lots of discussion all year regarding it, never passed anything. So the Inflation Reduction Act is actually a skinny down version of the former Build Back Better Act of what they were able to get past Congress. So if you want to move to the next slide, Adam, we're going to talk about just a few key provisions there. There's not a lot in here for individuals as well. There's actually 4 revenue provisions in there, and 2 of them have to deal with corporations. So a 15% corporate alternative minimum tax is going to be assessed on financial statement income for corporations with profits over $1 billion for tax years ending after December 31, 2022. So that's for corporations, and that is coming into play for 2023. There's also a non-deductible 1% excess tax on stock buybacks by publicly traded U.S. corporations for any stock repurchased during the year. So this is a corporate tax assessed and starts on repurchases after December 31st, 2022. So again, corporation, not something that individuals need to worry about. So then the IRS funding is a popular discussion point. The IRS got $80 billion of additional funding over 10 years to add auditors, improve customer service, and modernize technology. So the Treasury Secretary has stated that they recommend that funds should not be used to increase the likelihood of audit for small business or households making $400,000 or less. And there was a memo delivered to the IRS commissioner that they are supposed to develop an operational plan within 6 months. So that hasn't happened yet because it was in August of 2022, on how those dollars are going to be spent over the next 10 years on technology, service, equipment, and personnel. So we haven't seen any of that yet. There's also $15 million earmarked for the IRS to create an IRS-run free direct e-file system. So there's parts of that, but most of that is done through softwares now. So they're wanting the IRS to develop that, so everyone is going directly to the IRS to e-file. The Act also extends limitations on excess business losses for an additional 2 years through December 31st of 2028. So Abby's going to talk more about those rules shortly, so we'll just skip that for now. There's also some changes to the premium tax credits. Those rules regarding the 400% poverty line and providing additional credits to help with health insurance would have expired at the end of 2022. So that's now been extended to 2025. And then there's also been many credits that were related to energy and climate. So I'm going to talk about just a few of them that are going to impact the individual tax base. Okay, so the two most common that we see in regards to energy, the first one is an extension and modification of what was called the non-business energy property credit. So they've renamed that energy efficient home improvement credit. I think try to clarify the differences of all of those. So under current law, this was due to expire December 31st of 2021. So these energy credits have always been one of those things that have passed in the extenders bills. So current law allowed for a 10% tax credit on qualified energy efficient improvements and expenditures for residential energy property. Okay, so that was supposed to expire December 31st of 2021. The credit has a lifetime limit of $500. So many of our clients, it's been around for 10 to 15 years at this point, many of our clients have already used that $500 lifetime. So in the Inflation Reduction Act for 2022, they're bringing it back at the $500 lifetime level, the 10%. But starting for 2023, they're going to change the credit. They're going to expand it from 2023 to 2032. It's going to apply to energy efficient windows, doors, HVAC systems, and heat pumps. But instead of the $500 maximum lifetime credit, they're going to have an annual credit of $1,200. So it's going to be much more meaningful starting in 2023 because annually you can take that. It's also changing the percentage from 10% to 30% of qualified. And then there is a tax credit of up to $150 annually for having a home energy audit. It also is expanding the credit to personal property, but not just your primary residence. So that means a second home or a vacation home would now qualify for the this credit as well. So EnergyStar.gov is a great resource for what items are covered, the credit percentage, and the maximum amount on the different categories. So I would encourage you to go there. One thing as a tax preparer, keep your receipt, right? Keep that in there on our tax planner. We have a question whether you've put that property in, but if you just want to stick that information in your tax file, we'll figure out the best credit and what you have available for the year. So the second energy credit is the residential energy efficient property credit. So they're renaming this to be residential clean energy, and it relates to solar, both electric and water, fuel cells, geothermal, small wind energy, and qualified biomass property. So currently in 2022, this credit is at 26%. It was as high as 30% in 2019. It was scheduled to go down to 22% in 2023 and then expiring in 2023. So it's getting new life as well. They're extending it now through 2034. The credit is gonna be increased to 30% for 2022 to 2032, and then they're starting to phase it out in 23 and 24. That's so far down the road, they'll probably extend it again at this point. So the last credit I'm going to talk about is the clean vehicle credit. So they changed that mid-year as well. The current credit was for plug-in and fuel cell vehicles, and it was based on the number of units sold by the vehicle manufacturer. So once the vehicle manufacturer hit the 200,000, you were no longer eligible to take up to a 7,500 clean vehicle credit. So under the new law and going forward in 2023, the manufacturer limit is eliminated and they're splitting the credit $3,750 for vehicle meeting the critical minerals requirement, and then $3,750 for meeting the battery components. Still having $7,500 per credit, but kind of splitting it all up. One change, qualifying vehicles will have to have their final assembly occurring in North America. So that's really going to limit, because a lot of the electric vehicles are not final assembled in North America. So there could be a delay here in vehicles that are qualifying for the credit. This new rule is for vehicles sold after the date of enactment, which was August 16th of 2022. So as long as you had a binding contract signed prior to August 16th, 2022, you can use the old rules, which are more beneficial. If it's August 17th, 2022 or later, you have to follow the new rules. And then that is the rules for the rest of 2022 and 2023. So there has been additional guidance and frequently asked questions that are on the IRS website that do a pretty good job of answering some questions that could apply to you. The credit will not be allowed for income levels. So the lesser of current year or preceding years modified adjusted gross income at the $300,000 level for married taxpayers, $225 for head of households, and $150. So that is a negative, right? It didn't used to be based on income. And then it also has suggested retail price. They have to be under 80,000 for vans, SUVs, or pickup trucks, and under 55,000 for other vehicles. So they also put only one vehicle per year per taxpayer will qualify for the new credit, right? So that is an answered question as well. And beginning in 2024, a taxpayer can elect to transfer this tax credit back to the dealership in return for a payment from the dealer. So it'll be kind of interesting to see there, because you may not know what your income is, right? Until you do, right? There are things that happen during the year that change what your projected income is. So that seems interesting. They'll have to write some regulations there on how to deal with that. And then there is a new credit for previously owned clean vehicles. So starting in 2023, there's a new non-refundable credit for buyers of previously owned qualified clean vehicles, but there's quite a few restrictions on that. So it's from 2023 to 2032. It's up to a $4,000 credit, limited to 30% of the purchase price. There are again income restrictions, lower this time at $150 for married taxpayers, $112.5 for head of household, and $75 for single filers. And the credit will only be allowed with a sales price of $25,000 or less. Model year has to be 2 years earlier, and it has to be sold by a dealer on the original purchase. So that's a lot of restrictions on that. You can only claim the credit every 3 years. So there's a lot of detail in that one. And again, in 2024, the taxpayer can really give it to the dealer, and the dealer can give them the cash instead. But that seems to be have a lot of reporting issues with it. So One other thing we wanted to discuss is in regards to the recent Biden administration announcement on student loan debt forgiveness, right? The timing of that is up in the air. But the taxation has been clarified that it will be tax-free. Any student loan debt forgiveness will be tax-free on the federal level, and each state will determine whether it will be taxable for the state. Lastly, just want to reiterate no individual income tax changes for 2022 and going forward, even though there was a lot of speculation that there would be changes that would take place.
Quick before we go on to the next slide, we did have a couple quick questions on the inherited IRA RMDs. So I'll just read those quick. We will have a question and answer at the end, but I think these are quick, and so we'll just get those answered. Can you roll your inherited IRA RMD over to your own personal retirement account?
Okay, so the answer to that is no. The only person that can roll it over into their account is a surviving spouse. Otherwise, it's tagged an inherited IRA. So it would be an inherited IRA based on the life of Heather Gunderson, and then you are the beneficiary of that. So those are tagged. It's tagged ownership-wise, right? Adam, as you're doing the financial advisor is titling that account. And so no, the only beneficiary that can do that is their surviving spouse. Otherwise, it's considered an inherited IRA, which is tagged then of having to take that annual RMD, and it somehow tracking in the system will have to track that 10 years post-death.
Yeah, and then, I mean, ultimately, the government wants you to have that taxed, right? They don't want to have the ability to roll it over into your own. They want to tax you on that distribution, so.
Absolutely. That was the whole reason for that act, was to get rid of the ability to stretch that out off of the beneficiary's lifetime. Now the maximum that you're going to get is that 10-year.
The one, kind of way to maybe get around that is if it's maybe a small enough dollar amount and you're not already maxing out your 401k, you take that distribution, that money goes in your pocket, and then you increase your contribution to your 401k to reduce your taxable income by that same amount is kind of a little bit of a workaround. But if you are maxing out your 401k, you probably can't, use that little trick.
Right. It's a great reason for tax planning for these beneficiaries on the IRA accounts to kind of look at what your different scenarios are, different income levels, them retiring, right? Some of the things that we're going to talk about in the tax planning, there's real benefit there to looking strategically at that and seeing when the best time to take that is. It's not necessarily taking it out over the 10 years. It's going to depend on everybody's facts and circumstances.
And then kind of a tag onto that too, what is the amount of minimum withdrawal on an inherited IRA? And that ultimately depends on when you inherit. There's a lifetime table based on the age you are when you inherit, and there's a factor, and then that factor gets reduced by 1 as you move along, which ultimately increases the percentage of distribution. So I think if you do a quick Google search of inherited IRA RMD, you'll get to the table and be able to figure it out on your own, or certainly, ask your tax professional or your financial advisor should be able to help you with what that minimum withdrawal would be.
To make that more complicated too, those tables changed this year in 2022 because of the census. So they went back and redid that slightly based on what your life expectancy is. So be careful. If you take out based on the old table, you've actually taken out enough then, because the new tables have reduced it slightly. But even the IRS website refers to the new tables, but actually hadn't updated the publication in regards to that. So probably some safe harbor helping people in the future to make sure, in case they don't take it, just because it's kind of confusing for everyone this year.
I'm going to take that layup, that $80 billion will make sure that table gets updated quicker in the future.
Exactly. We hope so.
Yeah, moving right along.
All right. The 2017 tax law changes impacted the treatment of net operating losses, and those rules were suspended under COVID relief, but were back in play last year in 2021. And these changes impact business owners, and specifically 2 main things to watch out for. So first, if your losses are greater than your income from all sources, you would have a net operating loss or an NOL. NOLs are now limited to only 80% of your income. Secondly, any NOLs that are unallowed in 2022 are carried forward to future tax years. There's no longer the option to carry NOLs back 2 years and receive immediate refunds. Business owners should also be aware of the excess business loss rules. For 2022, a single filer can only deduct $270,000 of net business losses. Any remaining would be disallowed in 2022 and carried forward to future tax years as part of an NOL. So these are complex rules that could impact a business owner in a down market, and they really emphasize the importance of planning so that there's no surprises at tax time. This next slide also only applies to business owners, but we wanted to mention it here as it is a recent hot topic. So this is the pass-through entity tax, or the PTE, and it was created as a workaround to the $10,000 state and local tax limitation that was passed as part of the 2017 tax law changes. The PTE tax allows a pass-through entity, so a partnership or an S corporation, to pay the tax at the entity level, because the $10,000 state tax cap only applies to individuals. It doesn't apply to entity levels. The pass-through entity then is allowed to take the deduction as an entity level deduction, and then it flows through to the individual without limitation. So then the owners of the pass-through entity then either receive a credit for taxes paid on their state tax return, or they are able to deduct their share of income when determining their state tax liability. So as you can see, many states have recently enacted a PTE. The states have taken different approaches to their PTE taxes, and there are many complexities to this new PTE scheme. So again, this only applies to business owners, and there will be more business updates on tomorrow's business tax planning webinar, and there's still time to sign up for that webinar.
Okay, so looking forward to 2023, we're just going to kind of do some rapid fire here on some of the most recent changes that we're seeing. Social Security, the cost of living adjustment, right, at the 8.7% for 2023, right, is one of the highest ever. So that's going to impact retirees in the upcoming year. With that, the Social Security wage base has increased to $160,200 for 2023. That's up from $147,000 for 2022. And what that means is the 6.2% Social Security tax that is paid up to the $160,200. You know, that would be to wages or self-employment income. No Social Security tax is assessed above that. And then the Medicare tax of 1.45 is still assessed on all wages or self-employment income. Then the IRMAA adjustment. Higher income beneficiaries must pay more for Medicare Part B medical insurance and Medicare Part D prescription drug coverage. These adjustments are based on what your modified adjusted gross income is, which is usually your adjusted gross income off your tax return plus tax exempt interest. So that's from the tax returns 2 years prior to the current year. So for 2023, this is your 2021 tax return. So the additional premium amount starts at $194,000 for joint taxpayers, and that's $1 more. So obviously, when we talk about planning opportunities, we're also looking at retirees and how that's going to impact your Medicare, so that you're aware of that. There is the ability to file a form SSA-44 for a life-changing event, asking for a new review of the facts when determining this adjustment. So just bringing this up this year, if your income is substantially impacted by the market, this may be something that you want to consider filing. So examples of change in life status would be widower, divorce, a retirement from work year, loss of assets, income producing assets. So the form is available on the ssa.gov website. and should be completed and turned in when assessed the higher premium. So everybody's getting their letters October 15th through November 15th. That's when you'd want to fill it out. File it with the Social Security Administration and see what they say. I will warn you that I have seen it a couple times where a taxpayer has filed this and then subsequently their income has gone above the 194,000. And so the Social Security Administration does monitor that and would be happy to bill you for that additional amount after the fact. So at that point, you're kind of stuck paying it. 401k contribution limits are going to go up to $22,500 for 2023. This includes a $7,500 catch-up for participants that are turning age 50 or over in the current year. Retirement plan contributions have to be done through your paycheck prior to the end of the year. So you've got a month left. Everyone can review their paycheck and see where they're at and see if they want to take that ability to maximize that or do any more for the last month of the year. Individual retirement contributions are going to be $6,500 per person for 2023, $1,000 catch-up for those 50 or older. You must have earned income to make these contributions. And these contributions can be made up to the original due date of the tax return. So you have till April 15th to do that funding. Health savings account limits for 2023 for a family are $7,750. There is a $1,000 catch-up there as well, but the catch-up age for that is age 55. So health savings accounts that are done through your payroll and reduce your W-2 have to be done by the end of the year, funded. So you should review that to see if you need to do any maximizing. But health savings account contributions can also be done like an IRA through the due date of the tax return, the original due date, April 15th. So you do have the ability that if you have some room there, you could do some additional funding and take the tax deduction for the prior year. There is a pretty substantial increase in the standard deduction due to the inflation change. For 2023, those amounts are $27,700 for married filing joint, $20,800 for head of household, $13,850 for single taxpayers, and that's compared to $25,900, $19,400, and $12,950. The gift tax annual exclusion amount has increased again for 2023. It is $17,000. That's up from 2022 when it was $16,000 and 2021 when it's $15,000. So it usually takes 3 to 4 years for that to do another $1,000 increase. So those are some pretty rapid increases there. So just be aware of that. The estate tax lifetime exemption amount is increased to $12,920,000. So just under $13 million. That's compared to $12,060,000. So that's almost a $900,000 increase in 1 year, so beneficial. And then the tax brackets, if you want to, the next slide, if you look at that, all of them have increased about 7%. So that's a pretty hefty increase for the year. You see the 2023 brackets, you see the standard deduction amounts, and then for capital gains rate brackets, I was just going to mention those. 0 to 89,250 is your 0% capital gains rates. 89,251 to 553,850. That's going to be your 15% capital gain bracket for 2023. And then 553,850 plus is going to be your 20%. And those are the married filing joint. So single, married filing separate would be half of those.
Let's get into some year-end planning opportunities. So opportunity 1, managing capital gains and losses effectively.
All right. So Heather just spoke to the capital gains rates. They're listed on the right here for 2022. So as you can see, married couples with income below around $83,000 allows for 0% on long-term capital gains. So if you are below this income threshold, you can look for an opportunity to sell stock at a gain and pay no federal income tax. We often see this as an opportunity in the first couple of years of retirement before required minimum distributions or Social Security begin. Another strategy is tax loss harvesting. And most recent years, many people were fortunate to not have significant losses to harvest. However, of course, with the downturn in this market, this may be a good year for you to consider tax loss harvesting. So just a simple example on the left here, Jim sold DEF and XYZ stock earlier in 2022 for a long-term capital gain of $40,000. He also holds ABC stock, which has an unrealized loss of $40,000. He could sell that ABC stock, generating a $40,000 loss, and it would completely offset his capital gains from DEF and XYZ stock, and he would owe no capital gains tax in 2022. So a few things to keep in mind as you consider tax loss harvesting. First, up to $3,000 per year in net capital losses can be used to offset ordinary income. The rest would not be allowed in 2022, but you would have a capital loss carry forward to future tax years. When managing capital losses, you also need to be very cognizant of the wash sale rules. A wash sale occurs when you sell a security at a loss and then purchase that same security or substantially the same security back within 30 days. If you end up being affected by the wash sale rules, your loss would be disallowed. With the down market, we have received more and more questions around the wash sale rules, and you need to be very aware and cognizant of these as the wash sale rules apply across all your accounts, even within your IRA. The wash sale rules also do extend to your spouse's accounts as well.
Next, tax diversification for tax efficient savings and withdrawals. I'll take this one. This is more of a strategy for all times, not necessarily up or down market. But we talk a lot about diversification of investments, stocks, bonds, cash, the different asset classes. But in addition, we talk with our clients about diversification of tax buckets for their investments. So certainly you wouldn't want 100% of your assets in an IRA if you have the ability to contribute to a Roth or convert assets to a Roth. The ideal situation is you hit retirement and you have the three-legged stool: traditional IRA assets, Roth IRA assets, and then an after-tax like brokerage account. That diversification of buckets gives you that opportunity to do that year-end tax planning when you're in retirement. If you have only an IRA, you've kind of limited yourself to the tax planning strategies. So again, this isn't necessarily a up market, down market type strategy. It's more just a long-term, don't back yourself into the lack of tax planning opportunity there. Next, we have filling up tax brackets with Roth strategies. This is our opportunity number 3.
So a Roth account is an after-tax contribution that when you eventually make distributions are tax-free. So here's a number of strategies, and we'll walk through a couple examples as well. So a Roth IRA, in order to contribute to a Roth IRA, you have to have earned income. However, a spouse with no income can also contribute to a Roth IRA if their spouse has earned income. There's income limits. For 2022, it's $144,000 for a single taxpayer and $214,000 for a married couple. The total amount you can contribute to a traditional IRA and a Roth IRA is $6,000 or $7,000 for those over 50. A Roth 401k is a type of 401k that allows you to make after-tax contributions in your employer plan and then have tax-free withdrawals when you retire. So it's generally recommended when you are expected to be in a higher tax bracket when you retire and start making withdrawals. A Roth conversion, we'll go over an example in a minute, but it's when you transfer an IRA to a Roth and you pay the tax now to have future tax-free withdrawals. A backdoor Roth is when you're above the income limits we just discussed to contribute to a regular IRA. So for a couple, you're above $214,000 of income. You may consider a backdoor Roth. And again, we'll walk through an example of this. And finally, there's a mega backdoor Roth conversion. This is more complex. It's in an employer plan, and the employer plan needs to allow for after-tax contributions and in-service withdrawals. So we'll go over an example of Roth strategies. Roth conversions are a hot topic with the down market. These are the current tax brackets here, or as illustrated in this example as tax buckets. So let's go over an example. So Janet is currently in the 22% bucket. She's expecting in the future, because of her RMDs, Social Security income, pension income, to have higher income, and in the future to be in the 32% bucket. So what can we do for Janet now that she's in the lower bucket to help shelter some of her income from higher future tax rates? So Janet would work with her advisor to complete a Roth conversion over several years, converting $50,000 a year to a Roth IRA over 7 years to fill up the 22% bucket. So over those 7 years, she'd be able to move $350,000 to a Roth, and those funds would grow tax-free. This would also reduce her IRA balance, so that RMDs would also be smaller going forward, which is in that higher 32% bracket. Furthermore, her beneficiaries would inherit her Roth tax-free, which would especially be powerful if her beneficiaries are in a higher tax bracket. So on the next slide, now that there's market volatility and the market is down, many are considering this to be a good year to do a Roth conversion. So this is a very extreme example, but just to illustrate the power of converting when the market is down. In this example, the taxpayer's account was $200,000 and they had a 22% tax rate. They would pay $44,000 on a full conversion. Whereas if they waited till the market was down, say their value of their account was $100,000, again, assuming the same 22% rate, the cost of conversion would be $22,000. So either way, the market would fully recover to $250,000, but they would owe, again, $44,000 if they converted when the market was high versus $22,000 when it was low. And of course, there are many considerations when determining if now is a good time to do a Roth conversion. You should consider your current tax rate as well as your projected future tax rate. Heather earlier spoke to Medicare premiums. A Roth conversion could affect your future Medicare premium adjustments, so that's also an important consideration. Adam, what are you currently recommending for clients?
One quick note on when to do a Roth conversion. Certainly timing the market and getting your $200,000 account converted at $100,000 at the perfect bottom. You gotta be pretty lucky to do that. If we look back at the Janet example, where doing some multi-year planning and saying you're probably for the next 7 years going to do $50,000 a year, we might take that opportunity. And again, we might not hit it perfect, but that $50,000 conversion, if it's down at $35,000, it's still a good opportunity to convert. Even if ultimately it goes to 30, you still get quite a bit of recovery in that Roth bucket. In addition, and we probably maybe wouldn't do it so much with 50,000, but if we have clients, maybe looking to do more like 100, we could even do 50,000 early on in the year when the market's down and leave the other 50 because we don't know what's coming, right? We just know, hey, for this year, we want to do 100. Let's at least get some converted. If the market recovers, oh, well, at least we hedged our bets a little bit. So certainly that's kind of the thought process when we're meeting with clients. What is our multi-year plan? And where are we at in the market, and a little bit of where do we think it's going, but ultimately timing that market's going to be a hard task.
All right, the final Roth strategy is the backdoor Roth. The backdoor Roth allows you to convert a traditional IRA to a Roth IRA, even if your income is too high to directly contribute to a Roth IRA. So let's go over an example or the steps. First, you would open up a non-deductible traditional IRA and make an after-tax contribution. For 2022, you're allowed to contribute up to $6,000 or $7,000 for those 50 or older. You would then convert the funds to a Roth IRA. The conversion would trigger any income tax on the appreciation of after-tax contributions. And also, just as a warning, this strategy may be more complicated if you have other IRAs because of the IRS pro rata rules. Specifically, if you have significant pre-tax IRA accounts, this may not be the best strategy for you.
Moving on. Opportunity number 4, gifting strategies.
Okay, so we're going to talk about some charitable planning strategies. So just to go back, the Tax Cuts and Jobs Act increased the standard deduction for years 2018 through 2025. So they doubled the standard deduction. They limited state property taxes to $10,000. If you don't have a mortgage, right? We have a lot of clients who, with that increased standard deduction, aren't getting to the threshold where they're getting to itemize deduct and deduct their current year charitable contributions. So one strategy to consider for those who are above age 70 and a half is to consider the qualified charitable distribution from an IRA account. So a taxpayer can direct a transfer from their IRA account directly to a qualified charity. This distribution counts as part of the required minimum distribution. The taxpayer can report this distribution as tax-free. So you need to let your tax preparer know that you made a QCD, as the tax form comes with the full distributions for the year, and then a QCD adjustment is shown on the tax return to show that as tax-free. So the age eligibility for this remains at the 70 and a half, even though they increase the required minimum distribution to 72. So in order to increase itemized deductions to amount above the standard deduction, many taxpayers consider bunching their charitable contributions, doing more than 1 year at a time so that they go above that standard deduction threshold. Taxpayers look at itemizing every other year then and using the larger standard deduction in the off years. So one issue that can arise for taxpayers is they don't like necessarily giving all that cash to charity in 1 year and then not doing any to their church the next year, right? So one thing to review is a donor advised fund, which allows a taxpayer to achieve both of those objectives. With a donor advised fund, the account holder can put assets, cash, or appreciated securities into a donor advised fund, and then recommend which organizations and when the cash is distributed out of the donor advised fund to the charity. So they're front loading the deduction when the cash or the appreciated securities is funded into the donor advised fund. So if you look at the first slide, this is showing an example, right, where the taxpayer does not have enough to utilize itemized deductions and instead uses the standard deduction in each of the 4 years presented. Under the second scenario, an example is shown increasing the charitable contribution to $8,000 via funding a donor advised fund in year 1. And then years 2 through 4, the standard deduction is taken. Cash flow is the same, but the charitable deduction gets a greater tax benefit in year 1. Next slide, gifting of an appreciated security, right? Another way to fund charitable gifting is to donate the appreciated security directly to the charity versus selling it, recognizing capital gains, having to pay that tax, and donating the net. So as you can see from the example, about a $5,000 savings for donating this specific facts of appreciated security directly to charities. And then lastly, I've gotten quite a few questions the last month on charitable gift annuities. These are seeing some traction because of higher interest rates. So just wanted to mention that. A charitable gift annuity is a combination of a gift to charity and then taking an annuity payment back, which is based on your age. So you'd make a gift of property to a charity. It could be cash or appreciated securities in exchange for an annuity payout. The interest rate that you're paid is based on age and the charity. So there's an initial year charitable contribution amount for the actuarial value of the remainder interest, and whatever's left of the annuity at death goes to the charity. So we're seeing some questions on that. You know, if this is something of interest to you, contact your charity and see if that is something that they offer.
And then the last opportunity, year-end tax review. This is mine. So ultimately, you know, this is kind of the call to action. And again, I mentioned it earlier, We titled this in a down market just because we happen to be in a down market, but really every single year you should take a look at what your tax situation is and if there is some opportunity to improve it, and maybe not necessarily this year, right? Some of our strategies have you paying more tax this year to improve your tax situation next year or somewhere down the road. But certainly a call to action to take us up on an offer to help you take a look at what your current situation is and whether there are some moves that you should make prior to year end to help your tax situation not only this year but into the future. And certainly all of those strategies that we talked about would be in the consideration for that conversation. Charitable, filling up tax brackets, recognizing losses or gains depending on what you're trying to accomplish at the end of the year. And so now we do have time for questions. We got a little long-winded, so we don't have a ton of time, but I do have a couple already in the hopper. Two of them go to the energy tax credits. One, are non-plug-in hybrid vehicles considered a clean vehicle?
So I think the answer to that is no. If it is a hybrid that goes back and forth and has a battery backup in the car, I don't believe it's qualified, but I would encourage, anytime I get a question, I go to the IRS website in terms of, they have very good resources there available. And also from what I've heard, the car salesman, if it qualifies for the credit, is gonna let you know that. So those would be two places to actually look at your specific vehicle.
And then another one, I have a question about energy efficient and residential clean energy credits. Do either of these apply to updating the insulation in your home?
I believe yes, that there is energy efficient, like there's like an other energy efficient category. I would need to look there, but I believe that insulation does qualify for that, but would need to look for the new rules on that. From my understanding, the new rules are more generous than the prior years. So they have updated some of that. But again, there's great reference on the IRS website.
Another question about inherited IRAs. Can an inherited IRA be divided mother to multiple children? And the answer is yes, but it's upon inheriting, you have to either the next generation has to be specifically listed as a beneficiary, or based on your state rules, what happens as far as passing to the next generation. And before you actually take it into your own inherited IRA in your name, you'd need to disclaim the portion that's going down to the children.
Right, I would just clarify, beneficiary designation would need to say 30% child one, 30% child two, 30%, whatever that is. You can do a disclaimer post-death, but it's in your best interest to have that beneficiary designation be correct, both in a primary or a contingent in case that primary is deceased.
And then the last question that I see here, employee age 70 and a half plus currently contributing to the company 403B wants to do a QCD from their separate personal non-company IRA. Can they do so? Yes, right? If you have an IRA, you're allowed to do a qualified charitable distribution regardless if you're still contributing to a workplace plan. And if not, can they do a QCD from their IRA if they are, they just said if contributing to Roth 403B instead of traditional 403B, and that contribution to the employer plan does not make a difference. You're allowed to do a QCD if you have an IRA.
So 70 and a half.
Yep.
Is the key. You can't do it if you're under, and it has to be an IRA. It can't be qualified. A 401k or 403B. It has to be an IRA account.
Yep. And that's all I have for questions so far. Certainly we have 1 minute left until our noon end time. We have our information up there, so if you have one-off questions, feel free to send them along. Otherwise, thank you so much for joining us today, and I will end with our little disclaimer page. Make sure that gets up there. Heather and Abby, it was a pleasure doing this webinar with you. Great information as always.
Thank you, Adam.
Thank you.
Signing off.